Hello, good morning, everyone. My name is Peter. I run the insights team at Carta. Thanks for spending a little time with us this morning on this wonderful Monday, or as Dan happens to be across the world here, so perhaps not morning for everyone. Um, I am actually super excited about this conversation. This is someone that I have been following for quite a while. If you aren't reading all of his stuff, usually published on X, but hopefully a little bit more on LinkedIn as well. This is Dan Gray from Equidam. Dan, why don't you give yourself a little introduction here, and I can then tell the people why I love your writing so much.
Sure. First of all, thank you very much for having me. It's amazing to be here. I love a chance to talk about this stuff, especially with a fellow head of insights. That's great.
Indeed.
Um, so my background, I've been in and around startups for about 20 years, venture builders, accelerators, in founding teams. And now I'm kind of in this weird, like almost spectator position like you, where I'm looking at the venture market and the activity and the practices. And it's all fascinating to me, which I guess is why we're both here today.
Absolutely, man. But it seems to be particularly fascinating to you. I mean, obviously, I love another data-driven rationalist, as you put it, in the promo for this. But I think that there has been, when I read your stuff on X, it comes across as slightly different than other critiques of venture capital. And there's good stuff and bad stuff in your writing in terms of the way that you view parts of VC. But fundamentally, the thesis seems to be that this thing that we all love is broken. And there's almost a sense that other people are not taking that brokenness seriously enough. So, like, what is it about VC that gets you so passionate?
That's a great question. I mean, at the core of it, it's connected to the work I've done with startups, especially I guess on the accelerator side, and
Mm,
helping them trying to raise money, helping them dealing with VCs, seeing the struggle. Um, from brilliant, incredibly deserving founders with great companies who can't get an email back because like the system is designed in a certain way to select for certain people to an extent.
yeah.
That was kind of the introduction to all of this that caught my interest. And then over the years, it's been everything from like the financial side, where we focus with Equidam,
Yep.
understanding all like entrepreneurial finance, how fundraising mechanics, and recognizing like that there isn't the appropriate level of financial literacy in venture capital. That's one thing, but there's lots more. It's all connected to the same root cause.
Yeah. All right. Let's talk about the root cause then. So, everyone probably that is joining this conversation has some sense of the things that you have spoken about in regards to venture capital. I'm going to share this real quick. So, venture capital as an ailing asset class. So for those of you who aren't familiar, by the way, Dan writes these screeds on X, just completely blowing past the word limit, which is perfect. It's what you want. You love it. And the other thing that I love is you actually cite academic research within these articles. I have a bone to pick with you as to whether or not a lot of that academic research actually makes sense in those papers themselves. We can talk about it. I think there's
For sure.
argument, but give me the theory of the case from the very top level. Like, why is venture capital a sick capital class?
Sure. Yeah. Trying to boil this down to like a simple thesis is a challenge, but I'll try. Essentially, like we just came out of the longest, most significant bull run in history for venture capital. We
Ooh,
had low interest rates. At the same time, we had cloud and then SaaS, digital advertising, basically producing systems that would print money. You could put money in, they would sell dollars for 80 cents, but it would inflate the valuation to a certain extent and,
yep.
raise more money, grow more. And this lasted for such a long time, created a range of problems. On one hand, VCs kind of became spreadsheet investors where they were focused on relatively superficial characteristics. What is the basically ratio of like money into valuation growth to TVPI to fundraising to fees.
Yep.
On the other hand, uh, a lot of the and this is where we get back to the academic research. You see influences of things like the importance of relationships. Like everybody always says venture capital is a relationships business.
Hmm.
They say that because we just came out of this bull run. It's pretty well documented that relationships have a positive influence on venture capital in hot markets, and actually a slightly negative one in cold markets,
Hmm.
because you're not being congenial and marking each other up anymore, and things start to get a lot shakier.
Right.
um but to kind of round it out, it lasted for so long, it became so entrenched, all these behaviors, that VC changed in a pretty fundamental and like toxic way, I would say.
Is that changed? And I don't think that anyone would sit here and say that you're wrong about the fact that VC is different than it was 10 years ago. But is the vast majority of that change driven by the fact that there is so much capital involved that the asset class, by definition, must adjust to the level of capital available to it? And that itself explains the vast majority of it? Or there are like actual participants, the great man or woman theory of history here, where they're like, were choices other people could have made, and we would have been faced with a very different capital landscape.
Yeah, another tricky one. I mean, I think if you look at the net cash flows into VC in the past 20-25 years, there's a few years it's been positive and like pretty marginally positive. It's generally been negative, and like the overall trend is definitely negative.
Mm.
So the capital into VC has increased massively. The capital coming out of VC back into investors' pockets really hasn't. Um, so on one hand, the ability to allocate has definitely expanded, and that's down to all kinds of regulatory reasons, or questions about how attractive IPOs are, etc.
Yep.
Um, but the overall performance has definitely suffered for it, and this is kind of related to like what I call the financialization of VC, where as the amount of money available increased so dramatically, fees, which were already attractive as like the fixed income part of venture capital,
Yep.
became even more appealing relative to carry, which is the non-fixed like performance bonus side.
Right.
So essentially, GPs responded to this inflow of capital by redesigning how VC operates to maximize for that. So things like focusing on the incremental metrics, like how do we boost TVPI as much as possible to raise more funds as quickly as possible to maximize this fee income, rather than how do we aim for exits, and what makes a good exit, and what kind of companies make a good exit. These
Yep.
things got a little twisted.
So then that gets us to your first set of new words. I love people who can coin words in this space because I do think that venture capital, VC itself, is too broad a word. So venture banks versus venture capitalists. Give me a quick definition of those.
So venture capital is essentially, and this was lost in that like decade or so, but it is the discovery of like novel, interesting technologies with huge potential that require money, investment, to come into the world, but are
Yep.
way too risky for any traditional form of finance.
Right.
Venture banks are this like new beast that's appeared to basically absorb all of the extra capital, and they're really playing this like financialized game. Their whole thing is scale capital as much as possible, deploy as much as possible, raise as much as possible, you know, and that they have their own role in the ecosystem,
Right.
but it's not performance. It's not necessarily even like generating good exits. It's just like growth.
But is that strategy on their part in any way misaligned to their own incentives? Like, I guess what I'm asking is, do you hold venture banks, the biggest mega funds who are playing different games, responsible for not being traditional VC funds anymore? Or was that literally always going to happen if capital was available to them, right?
For sure. Yeah, they're playing the game, and
Right.
I can't blame them for trying to win the game as it is.
Yeah.
That's the incentives as they are. All I would say is like some of the stuff that's happening, particularly like venture banks acting as LPs, I think has some question marks next to it.
Mm.
Venture banks playing at seed as well is like, if you have like an AUM at that ridiculous scale,
Yeah.
why are you playing at seed? You're
So that you
shaping
can
the
take
market in
option
weird ways.
bets on the youngest companies and get in there first, right? So you can kind of distort the market to the then so that it fits your own preference stack.
Exactly. It's a problem, I think.
I mean, but that's not like gentlemanly, but nor is that unexpected, right? If you
Hmm.
have a financial market participant, they are going to try to bend the market such that their outcomes of success are more likely. Like
Yeah,
so,
for sure.
maybe I should explain my frustration here. It's not that I think that venture banks haven't distorted the market. I definitely think they have. It's that I don't think that I think this was a natural outgrowth of capital infusion into the space, and therefore the cries from emerging managers, while very right in some ways, are kind of like it's kind of like being mad at the weather. Like this was going to happen, right? Or like like if you put a certain amount of inputs in, certain amount of outputs are going to come out, and it's very odd to me that people, this pitch book chart got a ton of playback earlier this year, where it was like only 9 funds have ever raised $1 in VC, and it was like this is kind of what we should expect. If there's that much capital in VC, you cannot put $100 million into emerging managers very easily. You know, so maybe that soapbox is incorrect, and I'm missing something obvious.
Yeah, I would even go a step further, and I would say like I have and do continue to give like Andreessen Horowitz, for example, a lot of credit because I think
Mm,
what they did was really innovate the model of venture
yeah.
to accommodate for all this capital and make a product that works for like big sovereigns and the biggest pension funds, etc. They've made that work and they've become incredibly rich off the back of it. So good for them.
Yep.
My main contention is what we see now, like the opportunity today because of this, is that like the venture banks, and this is part of the reason why I like came up with this phrase venture bank,
Yep.
are like bifurcated. They are now like quite clearly doing their own thing with their own strategy at their own scale for their own base of LPs,
Yes.
which produces like the like low IRR returns at a very stable rate. But the main thing it does,
Yep.
hopefully, is it brings venture capital back to what it should be, which is like performance focused, shooting for exits. Um, not so much a financialized game.
So then you think because once we recognize as a venture community that these are completely separate ways of treating early stage finance, then the actual traditional ad venture capital will go back to doing what it did best and not trying to ape the mega funds when they don't have the capital to do so.
Yeah, and I think it almost has to because if you try and if you're a smaller scale like traditional VC fund and you're still trying to play in the same space as the venture banks, you're probably going to get crushed. You're going to get pushed out of deals, priced out of rounds. It's going to go badly. There's
But then
plenty of stories of
that
that.
brings up a really interesting point. If you're playing, so then that means you can't play at seed. We're talking that you have to be at a pre-seed fund, right? Because venture banks, to your earlier point, are playing across basically all parts of this capital stack. So how early do you have to go if you want to avoid their influence?
It's less about stage, it's more about theme, like consensus.
Mm,
So like for sure, like being a pre-seed and picking up companies. I saw Josh Koppelman from First Round. He
yeah.
recently shared a slide from his 2004 original LP deck,
Yep.
and he was talking about they were targeting seed to avoid this like auction mechanic. They wanted to get in first. That's now true today for pre-seed for sure.
Right. Right.
But on top of that, like it's mostly about theme. You should be finding, as Will Quist of Slow says, like the illegible companies, finding the stuff that is overlooked.
Yeah. That is so you are not allowed to invest into AI if you are a an adventure capitalist at the moment.
Unless it's doing something really wild.
Yeah. Okay. So you have to be on the frontier, the edge of it,
Yeah,
which
exactly.
it suggests in some ways that there should be fewer VC funds. I mean, how big is the edge, right? How wide is that width of that little ledge over the canyon? Probably not that wide. Or perhaps there's a different way to think about what money is useful for startups at what stage. I mean, we've been talking a little bit now about the venture bank, the mega funds versus the smaller funds. I wonder maybe if you would dig into your thoughts on like emerging managers. Okay, let's imagine this. Dan is starting an emerging manager fund. You're going to raise, well, this is a good question. How much would you raise? what is then an ideal size? How much money do you need to make a emerging VC fund work in your mind?
Yeah, good question. I mean, I think essentially you can make anything from like 50K to 100K can work. It's like whatever you can raise, really.
Mm,
Then it's like down to strategy.
yeah.
But from an ideal point of view, like if you follow the data about the best fund size for a non-venture bank VC firm,
Yep.
it looks like it's in the 250 million to what was it, like to like 400 million range, because
Yep.
that's where you have enough scale to diversify properly and also concentrate into the winners in subsequent rounds.
So this is one of the things that I think you get. It sparks a lot of debates on X and elsewhere. Is your version of portfolio theory, or not your version, the maths version of
Mhm.
portfolio theory? I think we could both say, which is fun, and this is something that I have come to believe over my 4 years at Carta. Fundamentally, the vast majority of emerging managers do not invest into enough companies.
Yeah,
They are too concentrated in their initial bet size. Why? Well, two questions. One, do you agree with that? And two, why do you think that is happening?
I'll take this question in a slightly different direction,
Please.
which is I saw a conversation recently about like data driven investing in VC and what that would look like.
Sure.
And it was framed by the person
I
as
like how you
like
say what that would look like because we've never had it.
exactly
Yeah.
like yeah, not much for sure. But the person was saying like if you did like data driven investing, you would end up with VC funds that like kind of copied the benchmark portfolio size and invested in like Stanford grads building AI in San Francisco
Mm,
because like that's the pattern.
yeah.
I was trying to explain like that's pattern matching. That's not really being data driven, and like the
Yep.
difference is understanding statistics.
Yep.
If you were to me like from my perspective, if you were a genuinely data driven emerging manager, let's say you you know there may be some advantage to being a solo GP, perhaps,
Yep.
for like consensus reasons. You would be a complete generalist. Um, you would definitely have like a more diversified portfolio than is standard.
Yep.
There's a ton of very like non-consensus things that actually emerge if you really follow the data. Like, and
Yeah.
that difference between like, do you model like a benchmark style small concentrated portfolio or go for the larger one? Like, it's not intuitive to people, I think.
And this, I'm trying to find the thing that sparks a ton of this conversation on X. Sorry if this has been bouncing around for everyone on the call, but this chart that I'm looking for illustrates sort of the idea at the commonly held definition of seed stage, right? Which is you're going to invest. There it is. There's about a 0.5% to call it a 2%, 2.5% chance that any single one of these companies at seed is going to produce a unicorn outcome. We can talk about whether or not unicorn is exactly what you should be shooting for, but I think it's a useful
Hmm.
threshold here. So the idea is that if you are pushing into your fund 20 portfolio companies, the likelihood of any one of them becoming a unicorn company is too low for the like bet of the math for the LP, especially. And so the idea is that you would want 40, 50, or even I believe if you take your math very seriously, 100 portfolio companies into this, and that would be a better bet. Why do you think that VCs sort of naturally sort of recoil at that math? Because I
As,
hear when I've talked to this to VCs, most of the initial reaction is ugh, no.
yeah,
Yeah.
for sure. Yeah, I'm gonna blame this on LPs, to be honest. Like that,
Okay.
it's kind of their fault.
Congrats to VCs. You're off the hook. Well done.
Yeah, for a little while, for a little while.
Sure. Yeah. Until the latter half of this conversation. Indeed.
Yeah. So like the big issue across VC, I would say, is primarily related to the disconnect between GPs and LPs. Like the
Mm,
way that LPs evaluate, select, screen GPs is kind of shocking. Like if you listen to like the criteria they use or like the due diligence they do, or even the like the level of understanding they have of like venture outcomes and venture math, it's not great.
mm,
So the truth is, if you're pitching an LP and you want to raise a fund, if you go to them and say, we're going to invest in 15 companies,
Yep.
all going to be AI companies, all going to be based in San Francisco, they're going to be like huge generational outcomes.
Right.
You know, we expect 5 out of the 15 to be unicorns.
Totally.
LP is going to be like,
That's an average success rate. 5 to
yeah,
15.
exactly.
100%. Yep.
But
That's
LPs love that. If you can sell them on the narrative, that, you know, that's how you get them on board. And then LPs have this theory that they then diversify that risk away through having a portfolio of GPs. But
mm,
actually, what they just end up with is like a stable of crap.
mm. Because their fundamental investment criteria is predicated on the wrong things. So their quote unquote diversified portfolio is basically just a bunch of people doing the same kind of thing. And maybe they wrapped the story in slightly different ways.
Yeah. And whereas like the flip side to this is if you go to LPs and you say, "Oh, we're going to raise a diversified portfolio of 100 companies. We're going to be like super non-consensus, so we're not going to chase AI, and we're expecting like a 3 to 4x multiple."
Yeah.
They're going to be like, "Ah, it's not interesting to us, I'm afraid. Like we're already diversified. We don't, you know, we don't really care. We don't think you're chasing the right things."
Yeah.
Even
So now,
though, sorry,
go
go on.
ahead, please.
Even though like like, and this is where you get into like the returns math, and it where my like blood starts to boil a little bit. The long tail of returns in venture, which is super long and super thin, like the far out like 100x funds are incredible, but they're also unnecessary in a sense compared to
Mm,
like the fat head of funds that lose money. Like
mm,
the first 50% struggle to make it to 1x. So
right.
that's half the money, you know, basically in like
Gone.
catastrophically performing funds.
Definitely.
You have to get to the top 10% ish for it to be a 3x.
Yep.
Where what LPs really want, generally speaking, and like LPs all optimize for slightly different things, but like generally, if they got consistent 3x returns from a VC, they'd be pretty happy. So
Right.
why aren't GPs building funds around that? Why are they all shooting for these super high multiples, but then delivering like a mess of different outcomes?
Right. So this is the part of the math that I think deserves to be doubled down on, which is the idea that in order to achieve a 3x outcome, if you have a portfolio that is 2 to 3 times larger, you are less likely to achieve, excuse me, you are more likely to achieve a 3x outcome, but less likely to achieve a 5 to 10x outcome. And the
Yeah.
question is, during your pitch and during the initial conception of your VC fund, would you take 3x really is the idea, right? Like why I think that this gets into the other article that I was showing earlier, which is your sort of railing against power law because power law has become a meme rather than an actual like implemented idea, which is
Hmm.
the only way to make money in VC is to be super power law focused. Whereas actually, if you bet on a diversified, much larger portfolio of companies, you could, through math, not ensure, but insulate yourself from the very negative outcomes. And I swear, when I talk to emerging managers today, if they had had a track record of 2 to 3 funds that each returned between 3 and 4x, they would have much less trouble raising. So in some
100%.
ways, I don't know why it's not a more common strategy.
Yeah. And it's also like, it's not necessarily that you make a 3x return more likely. It's more like if if this was a general practice, if diversified funds were more common, that like bell curve of returns would shift to the right. Like
Yeah,
everybody would do slightly better. But a really good GP, even with a diversified fund, could still do like 7 to 10x, like in theory, if they were a great picker. Like
yeah.
the portfolio modeling is always an average. You can definitely outperform an average.
Absolutely. And it's interesting because I don't think that the idea of a picker in venture capital, sort of the je ne sais quoi of the venture fund manager's like reason for being is that I will have differentiated access and I will have differentiated ability to choose from amongst that possible pool the right companies. And I think that to double down on a point you just made, that doesn't go away if you invest into significantly more companies. It
Yep.
just becomes actually, in some ways, more important because the gating criteria is your access and your ability to pick again and again and again. And this gets into conversations that I've been having, and I keep throwing things into the chat, folks. I know Brandon, you've mentioned a couple things I want to get to. Uh, one of the things I keep having conversations with on emerging managers is the role of reserves and concentration. And I, I have to be honest, a lot of the times when this topic comes up, I am met with this sort of default response, which is you have to concentrate in your winners if you want to make it in VC, right? That's like, and then I ask, well, what does that really mean? And it kind of seems like rule of thumb ish, reserve 40% of the fund for follow ons.
Mm-hmm.
What do you think about that?
Yeah, I do think like step one for sure for everybody should be ensuring you've got the fund size for reasonable diversification. Like
Yep.
that's got to be the beginning.
Yep.
From that point on, like I would say the next step as you like build track record and can raise more capital is then either you can expand that further or you can start to concentrate more.
Yep.
There is some like there's put some portfolio modeling that's been done around like how you should break it down stage by stage for follow-ons. Like I'm a bit fuzzy on that, partly because like rounds are constantly changing, time between rounds, size of rounds. Like that modeling does get a bit fuzzy.
Totally.
I do think it's important to concentrate into winners. You have to treat every new round like an entirely new round, like no priors, no loyalty to the company. Like you have to really justify the round.
Yes.
um but yeah, how you break that down, what percentage of the fund, that's going to be strategy each time.
It's pretty tough. Okay. So then we get to Brandon's question, which he's kind of said multiple times here, which is, yeah, okay. I kind of, on a high level, I think that this math checks out, but you cannot pitch as an emerging manager VCs. You cannot sell VCs on this outcome. So
Hmm.
where did VCs, I guess perhaps a history lesson if there is one here, where did VCs get acquainted with this idea about concentration and a diversified portfolio not being venture backable?
That potentially is where you get into like some of the deeper systemic flaws. For example, the extent to which large institutional LPs are compensated based on TVPI.
Eh,
So
or
what,
IRR? Rough.
or IRR, exactly. So what those LPs want
Yep.
fundamentally is VCs that make investments that grow incredibly quickly in value. So that
Yep.
means concentration. That means chasing hype. That means consensus themes. That means piling as much money as you can into, for example, AI or Web3 or whatever it may be.
Yep.
So diversified funds that are looking for genuine outliers and like contrarian stuff just stops being interesting.
Mm. It also strikes me as the idea that the first fund or the second fund, which may be slightly more contrarian, has within it a drift. The fund cycle and then becoming a generational firm has within it a drift towards consensus, uh, almost by definition, because as you're raising more money, you are investing into bigger checks, et cetera. So like the Charles Hudson idea around actually, and this is perhaps taken from benchmark, that you should basically just raise the same fund every time, maybe accounting for inflation, and like stick to what you're good at. How do you feel about that approach versus becoming a firm?
100%. Yeah, I think I've cited Charles on that as well in the past.
Yeah.
I definitely agree with his thinking. The only thing I would add to that is just like a small thing about this like GP LP connection that really surprises me.
Mm.
The GPs can expand their fund size in subsequent funds without really having to give any justification. Like if a founder came to you and like wanted to raise a certain amount of money and then came back to you later and wanted to raise twice as much, you would definitely ask like, why? What's
Why?
the strategy? Where are you going
Right.
to spend it? What's it going to do?
Right.
It doesn't happen so much in VC.
Yeah, for sure. Which gets the fundamental crack in perhaps this edifice is the stories that have to be told from GPs to LPs and candidly from LPs back down to GPs, and why those stories have become so ensconced and unchangeable. I think we could talk for another 2 hours on this. I did want to jump to a couple other topics, but Also, everyone who's listening live on YouTube or LinkedIn, etc., if you have topics or questions for Dan or I that you want us to get into, throw them into the comments. The second, or one of the other topics, Dan, that I love that you touched on is everyone's favorite new thing in venture capital, new in quotes, which is secondaries. What is your view on secondaries broadly? And then let's talk a little bit about how they actually could play a more meaningful role in liquidity writ large.
Yeah, definitely. I get that pretty cleanly breaks down into those two questions. So I think today secondaries have this purpose of like essentially serving the needs mostly of the venture banks with the giant like perma private ish companies,
Mm,
Stripe, SpaceX, that kind of caliber,
sure.
where they have no need to go public. Everybody knows like the governance is pretty good, the growth is good, the business is incredible. They can stay private, and secondaries are there as like the little like valve to make that work.
Yep.
It doesn't help anyone else in that format. And I think there's a lot of faith in this like venture bank model that is going to scale and apply to a lot of other companies. I'm
Mm-hmm.
not so sure it will.
Say more about that. I have my own suppositions about. So, one, I think it's very obvious that secondaries as a topic exist so much in the minds of people because IPOs are gone, right? So,
Hmm.
like in the search for liquidity, this topic is evergreen. It comes up whenever there's a lack of liquidity. But as you know, someone who sits on data from what 45,000 startups, I'll tell you today, if all 45,000 of those startups were publicly liquid and you could trade them, I'd say 44,500 of them would never trade. There would be no market. There would be
Yep.
no demand. So that to me, and maybe I'm stepping on your point, is the issue with secondaries. It is not necessarily a mechanics or a techniques or whatever problem. Some of it's mindset, but a lot of it is just demand. It doesn't exist for the vast majority of these privates.
I think it's partly demand, but I think the demand problem is fueled by adverse selection,
Mm,
which is essentially like you have a low information environment in private markets. We don't know, like, even if you know the details of one company, like financial performance, valuation, share
yeah,
price, you can't see the rest of the market. So how do you make a good judgment?
yeah,
So in that environment, if the only real information you have is that current holders are looking to sell, like it's kind of a red flag, though at least it feels like a red flag.
yep,
So that's going to hold back everybody. That's why secondaries from 2022 until now have been at such a steep, like slightly recovering, but like a steep discount.
yep.
The only way that gets fixed is if secondaries become like a staple, like a fundamental part of venture, particularly like early stage managers across the board. If they all had a really robust secondary strategy
Yep.
and there was a bit more transparency in that process about performance and benchmarks, that could turn around.
But how do you incentivize an ecosystem to include secondaries as a fundamental plank here, right?
Well, I mean, to be honest, I think they should already. Um, if you look at what can be done, like I have another post on this that looks at like the average TVPI of a firm over time,
Yep.
and in year 7, it's kind of at the peak. So, like for the best IRR possible, if you theoretically sold everything in year 7,
Yep.
you do better than if you sold everything in year 10.
Yep.
So there's definitely an opportunity to sell holdings earlier. Also, with the failure rate, even of later stage venture backed companies, like you can make a profit off something that may later not work out. And
Yep.
when you're an early stage manager that is now exposed to all of the risks of later stage capital, and like especially with the re-risking that happens with the huge rounds of capital, like
Mm.
you probably don't really want to be exposed to that. So like
Say that.
for
Say
sure
that word
selling.
again. The re-risking of late stage capital. What does that mean specifically?
So this is a concept I saw Rob Go posting about. So he has a
Yep.
great graphic and a little write up on this. But essentially, it's if you chart the risk of a startup over time as it raises money,
Yep.
it kind of like increases a little bit every time it raises because now it has future expectations with money in the bank and targets it has to hit.
Yep.
When you add in, like, especially like venture banks and the incredible volume of capital that they pump into companies, that risk goes stratospheric. So the re-risking is essentially like, if a late stage round is large enough and ambitious enough, you're now back at like seed stage levels of risk.
Right, with a ton more capital on the line.
Exactly. So like if you got into that company at pre-seed, do you really want to be a part of that, or is that your opportunity to get out?
Yep. Yep. And it goes back to, it's so funny how when you scratch on these concepts, you can scratch over one layer, which is what people are saying. You scratch down to the second layer, which is what the math is. And
Hmm.
then you scratch down to the third layer, which is what the story was 10 years ago when people thought about this part of the market. And the story was secondaries are a sign of lack of conviction
Hmm.
and a stigma attached to them, both on the early stage funder and founder side. And if there's one thing that I think some of the downturn has done, or even if you want to credit it to the boom in 21, it's removed little bit by bit some of that stigma, which I think is a very good thing. Uh,
100%.
there is nothing that we are gaining by the idea that if you only keep money into the startup until it IPOs, that's the only way to make money and that's the only good way to treat these companies. I think that's completely silly. Um, the re-risking part is super interesting because I think we're seeing it now with the IPOs that have gone out or the IPOs that are being spoken about right now. Everyone is quote unquote a down round, right? The
Hmm.
latest stage investors are not necessarily seeing those capital lows, but they're not Stripe, they're not SpaceX, so they can't stay private forever, and they need to like have some sort of liquidity cycle. How do you feel about funds holding from beyond public, beyond the IPO moment?
I forget who said this, but like that someone has commented on this with the very like astute observation, like that it's not what your LPs paid you to do.
Sure.
Like if they're paying you to manage private companies, then like at IPO you should probably get out.
Yep.
What I would kind of add to that is similar to the idea of early secondaries. If you can take enough money off the table early
Yep.
to like account for the risk of holding longer, then sure. So like, maybe there's something to like holding some and selling some. So there's a like a mix that could work.
Mhm.
But in general, like the number one thing is DPI and getting DPI to your LPs as soon as you can.
Yes. And that last part is the key. As soon as you can, if
Hmm.
you can, right? There is such I feel like part of the why the math in venture is so weird is because people assume such a long time horizon that they forget that time matters.
Yeah,
And
for
actually it
sure.
matters almost more than anything else. And if you can get 1x your fund back in the first 5 to 7 years, you've done more for those LPs than the 2x at 14 years will do for their cash flows. Like the cash flow truly matters.
And there are LPs that benchmark to that, to
Yes.
like the 1x.
Yes.
People don't
Yes.
talk about that, but like it's for sure important.
Absolutely. And maybe we should speak for a moment about the difference between when you use the term venture LPs, are your critiques mostly driven towards like the endowment, the institutional layer, or is it just kind of a broad based thought pattern that you see across, from family offices to funds to et cetera? Or are there distinctions between those types?
I broke it down earlier today into two basic categories. There are LPs whose number one
Everyone, this
priority.
is why Dan rocks. I asked him a question live, and he's like, "Yes, I wrote a long piece on that earlier today, of course, because the production function is super high to use the Tyler Cohen idea."
Actually, this was in like a little argument with Dale Johnson in a response to something else. So
All
it's
right, so
not
my
quite a long write up yet,
fair enough,
but I'll get there.
for
But
sure.
like essentially, it's like there's the one group of LPs where the number one priority is returns. Like they want DPI on a good time frame. That's what they care about.
Yep,
Surprisingly, like that's a pretty small amount of the overall capital.
yep,
The other group of LPs are the big institutions where you're not dealing with the person whose money it is. Like the allocator to your fund is in charge of, determining who gets funding,
sure.
but it's not their money. And
Yep,
maybe they get compensated based on IRR or TVPI.
yep,
So what they're looking for again is like those fast markups and the consensus and the all that financialization.
hmm
And like they don't care. Like they're not going to be around in 5 years. They'll have moved on to something else. So
Yeah,
they won't even see the end of the fund.
right. This does get back to your initial point about relationships, which is the non-monetary incentives, or even the monetary incentives that are not long-term aligned of the LP class, can trip so much of this stuff up. So I think it's kind of it's weird to be in a part of venture, or excuse me, a part of finance that is spoken about. VC gets more ink, digital and otherwise, than any other part of the economy, it feels like, and yet it has the most hiccups and lack of financialization and like real misunderstanding of math. And some people point to that as a feature, and some people point to that as a bug.
It's definitely a bug.
Yeah, no, no. Um, there's there's been a ton of comments and everything on the chat. There's one that I wanted to throw in, which is like, what is your opinion? Would the best imagine a world in which the LP class and perhaps even eventually retail investors could simply indexed venture in an ETF manner? Would that be the best way to invest into this asset class for most people?
For retail investors, I would say almost certainly not. I
Mm,
think there is a place for retail in venture, but it's like individual investments, and even then, it's like largely not driven by returns. It's like maybe ideological. They want to support a cause or a company or whatever.
sure.
Funds generally, like why would you choose it over the S&P?
Yep.
It's a very hard case to make.
Yep. Yep. Um, I I want to disagree with that because I think it would be really cool to bring a product like that into the world. But I think on a maths basis, I have very little quibble with it. The one, unfortunately, the one part where maybe that is an issue is, uh, I mean, does your view on venture change based on the length of time it takes for these companies to come into the public market? So there's been an argument lately that the continued private status of people like SpaceX and Stripe, et cetera, is to the detriment of the American and global retail investor because they basically get no access to those companies. So, what's your opinion on whether or not that part of the market requires a shift in order to sort of broaden access to the best of those light privates?
For sure. Yeah, I think that's very true. But I think it comes with the important caveat that obviously when you become a private company, you have when you become a public company, you have reporting requirements.
Yes.
You're held to a standard on financial health, on governance, on a number of very important things that ensure the like mid to long term health of the business. And
Yes.
that's I think is crucial. And I really think this goes back to the point about like Stripe and SpaceX and the perma private companies. What's missing from that model is like people really underestimate when you're at year 10 or year 12 of a private company, how far, like, what is the divergence between price and value? Like, how
Mm,
good is the price discovery? Like, to me, it gets really shaky. Um,
yeah.
and I think that's gonna like be pretty ugly when it all comes out in the wash.
So talk to me more about pricing then, because this is obviously what Equidam does, I think, every day. You wake up and you price companies, you don't value them, as I've been taught. So talk to me about the mistakes or weirdnesses that come along with the way that venture does valuation, or that founders or investors think about it.
Well, first, let me give you a small anecdote to explain this because I've used this a number of times and it seems to land pretty well.
Please.
Have you ever watched a show called Antiques Roadshow?
I sure have.
Okay, great. That it gets difficult if you say no to that. So people bring on an object, they take it to an expert, and the
Yep.
expert appraises it, and they look at like who made it, when it was made, how rare is it, what condition it's in, all of these different facets. And they
Totally.
tell the person, like, based on this, you can expect a range at auction of like 1.5 to 2 million.
Yep.
That's valuation. Then they go to auction and they like can set an opening bid based on that valuation. But what it actually goes for in the room could be very different. It depends on who's in the room. Like maybe something's happened with the creator of that object recently. Maybe there's been like a hot like trend of sales.
Yep.
Could go for five. It could go for 500,000 at the end of the day. that's price.
Yep.
Like, and that's what I think a lot of people miss in the distinction between the two. So what we do is valuation, and for sure it's an opinion. We try to be as like data driven as possible about it.
Sure.
But it's like that, yeah, that distinction is where like a lot of VCs get hung up because they kind of don't understand it.
What are they mistaking about valuation? Because obviously price in this context doesn't exist for them at the moment in which they make these judgments, right? It is a valuation by definition.
They kind of see VC as like just the auction house without the appraiser, and
Mm,
without the expert in the room to give
yeah.
any feedback. So it's like just the auction. You throw it in the room, you see what people are willing to pay, and it goes for whatever someone is willing to pay. And there's
Yep.
no expectation setting. There's no like exploration of the details of the thing necessarily. It's just like a bidding contest on maybe something that they don't even particularly understand very well.
And they are even within that context of saying this is a bid and I am a part I'm lacking an auctioneer, but I am in an auction. What else? Because it seems like there's a root cause to some of these problems, which is to say they are not optimizing for a valuation that works for an eventual price. They are optimizing for a valuation that works for the next valuation, if that makes sense.
100%. Yeah, that's another big problem. Very much connected to this. I've seen some very big names in VC talk about like setting a seed price based on like making it a quarter of what you think the Series A is going to be. And it's like, do you have a time machine?
Right.
That's insane because they want like a 4x markup. So like that's how they do the math. But like it's just wild. It doesn't make any sense.
So do entry prices matter? This is a trick question.
Yeah, of course.
Of course they do. This is the dumbest thing around venture that I can't understand. It's like maybe you're having a separate conversation and you're using the word entry price in different ways, but it literally boggles the mind how you could think that entry price doesn't matter to eventual. You might say that it is immaterial to my strategy, but you cannot say it doesn't matter.
Yeah. I think this is another one of the problems that came out of that like SaaS driven bull run.
Mm,
If everything's a money printer and it will make more money as you put more money into it, then for sure entry price doesn't matter.
yeah,
Or if you're a venture bank, if you're Andreessen Horowitz, entry price is actually like a weapon. So like
right.
higher in a sense is better.
Yes,
Now
exactly.
in
It
this,
matters. It matters as a tool to compete, right? But it doesn't not matter.
for sure.
Yeah.
If you're trying to run like a well diversified portfolio, of
Yep.
course it matters. Otherwise, you
Yes.
can't get the ownership you need in the companies.
Yes. All right, we have like 20 questions that we could answer here. I'm going to take us in the last 10 minutes through two or three of them. The
Sure.
first one, and I just wanted to touch on this because it's the conversation that I am having more than any other these days, which is seed strapping. Our new talk about coining a phrase. Natasha at Information did a good job with this one. Everyone is talking about it. What do you think that founders and investors get wrong about seed strapping as a concept?
That it's gonna last. Like
Say more.
it's an interesting concept for the market today when fundraising is a headache.
Yep.
As soon as the market starts to really rebound, which is basically as soon as rates start to go down again,
Mm.
everybody's going to be
Wait,
raising money.
interest rates matter? I was told otherwise.
Yeah, macro is surprisingly relevant to venture. It
Mm,
turns out.
indeed.
But yeah, if everybody in your peer group is raising more money for growth, you're going to have to.
Yes. And you don't think that AI fundamentally changes this thing with the lack of payroll needs, et cetera, like companies being produced smaller? That is a function of the macro environment, or is that an actual sea change in the way that companies are being built?
I think it's just the macro.
Mm. I, I want to believe that this time is different, but I do look at past times and say, well, if there was more capital available, people would be hiring more, and that's just the way that it works. Maybe I'm wrong. This
True.
this definitely could be a different one. All right, a number of questions around, um, your conceptions of the lack of financial literacy in some ways within venture. Do you think that venture itself would benefit from a practicum, a certification of some kind?
Yeah, and I have to give a little shout out to Joe Millam, who I know is watching. He's the guy who like I spoke to him about this like maybe 6 months or a year ago now. This
Yep.
idea of like a VC curriculum, especially around financial literacy, behavioral finance, portfolio construction, all of this stuff matters an incredible amount. And
Yeah.
it's like damning how poor the average understanding is. If there was
And
like a voluntary certificate where you could, like, when you were pitching LPs, just say, by the way, I've done this course, I'm familiar with at least the basics. That
sure.
has to be a good thing.
I don't know if VP any LPs today would value that, which is the problem if you're working towards a lack of understanding of the chain.
Yeah.
Yeah.
Yeah,
No,
that's true.
I get it. Yes. And thank you, uh, Joe, for jumping on. I know that you're on the call and listening to Dan talk your stuff up, which is great. Um, okay, the last sort of set of questions, which is all around like how wave a wand over venture capital and change one or two things about the system or the incentives such that there are better outcomes for more people. What would you change first about the asset class?
I think that the first thing has to be, like, if we kind of accept the idea that like the LP class has also bifurcated, there are some who chase like this financialized venture bank model, and there are some who want performance.
Mm-hmm.
If we accept that that's true, it's that the ones who want performance realize that they too have to understand what it takes to be a good GP. They need to educate themselves. They need to understand, they also need to understand like the portfolio math, the behavioral finance, all this stuff.
Yep.
The other thing I would say is like there's a real resistance to things like having an open standard for valuation, because if one person does it and nobody else does, then like you're the odd one out. You're
Yep.
also the one who's like kind of telling LPs what the real value of investments are, which may
Yes.
clash with what other GPs are saying they are.
Yep.
So you're not going to
We
be
just talked how
popular.
often that's asked to us at Carta. Could you, in some way, shape, or form, submit a quote unquote real valuation onto which we can map the
Yep.
different marks held by GPs? It's asked, I mean, we're asked that every day.
Yep.
Um, and to your point, it puts this weird onus. It's like, well, okay, that we could do math in various different ways and come up with a valuation, but the problem is not the math. The problem is the culture. Like,
Hmm.
what does that do for us or to us or with the different stakeholders involved? And it just gets back to the same question I always have about VCs: like, is this a relationship problem or is this a math problem? And it's
Hmm.
almost always the former, not the latter.
True.
Yeah. Um, what else? Is there anything else around venture that you think you would wave that magic wand and destroy or improve?
Well, destroy would be like all the dogma, all the like old historical ways of thinking and like industry folklore. Very little of it makes any sense. It's super misleading. It entrenches a lot of bad practices.
What's your least favorite one?
Well, like entry prices don't matter is a strong candidate
A
for
good one. Yep. Yep.
garbage,
For sure.
or the concentrated portfolios. That's a bit more up for debate.
Yep.
But at
Um,
the same time, like you can't scrap all of it. There's little bits like, you know, Peter Thiel has said, if a space is competitive, like it's not worth being in. That to me
mm,
is actually a good, like solid piece of foundational wisdom for venture capital, but that is forgotten for some reason.
well, sure. It's difficult to find spaces that are not crowded these
That's
days.
the
It
job.
takes more work, indeed. 100%. I'm with you. I'm with you.
Yeah.
All right. Last 5 minutes. I wanted to spend a couple moments on your diet, your media diet, your venture diet. Like, who do you read? What do you listen to? How do you like imbibe information about the asset class?
Generally, I kind of start with like it's like a 3 point view on any problem.
Mm,
So there is like the way it operates today. So that's like a data thing.
yep.
And there I'm looking at like data from Carta. The data you put out is obviously the best in the business. There's
Mhm.
the theory perspective, which is like how it probably should operate. Like what are the incentives? What's the outcome of that?
And
In more of like,
is that theory driven by like the research academically that you're reading or your own conception of the world? Maybe both.
That's like more like my own conception. Like
Okay.
based on the reality versus how I think it should be. Like what's the delta between the two and like why might that be the case? And
Yep.
that's when I start looking for research. So
Yep.
there is like in the past it was like Google Scholar and a lot of like horrible manual work. Now it's a bit more like LLM driven, but
Sure.
always using primary sources. I like huge red flag is people who post screenshots of ChatGPT or whatever.
You don't think deep research knows what it's talking about?
You'd be amazed what I've got it to say in the past. That's crazy.
I wouldn't actually. I've equally got it to say some ridiculous stuff, and I use it all the time. But yeah.
But I think like the like completing the triangle. So it's like the really good industry reports, like Carter's, um, the academic papers, and then like my own sense of how things are, which is really like informed and either reinforced or contradicted by everyone else's opinions. So that's like X LinkedIn.
Yeah. Yeah. I try to minimize the amount of time I'm spending on X these days because I feel like it has so much good signal, but the signal to noise ratio has gotten so whacked that it's very difficult to find things that I like intellectually disagree with but respect, as opposed to things that I don't respect and also disagree with.
Mm-hmm.
And like then it's just not worth the like thinking space. But I'm having trouble. I guess I'm trying to tell you I'm weaning myself off of the X addiction.
It's
I
tough.
don't
I
know.
mean, I follow 300 people religiously. Like, if I add a person, I have to remove a person. So I would say I
Ooh.
probably now follow the 300 most interesting people in VC. Like, that's a shout out to everyone I follow there.
Congrats. You've made the list. I
Yeah.
mean, I was going to end this with a shout out to everyone to follow you on X, because you and Arthur are the two people this year, and Endowment Eddie, who is a, have you met Endowment Eddie? Is he a real person?
I can't confirm or deny.
Uh, it's ridiculous. Uh, those are the three people that I've followed this year that have provided me the most genuine, thought provoking. I mean, Arthur is just like, wow, I feel very in the know. But you two have provided thought provoking conceptualizations of ways that you should think about this asset class. So, I mean, in summary, I know we're at the last time here. I wanted to thank you for the work that you've been doing. Keep publishing, keep writing, keep challenging people on their fundamental assumptions, because I think we are a better group of people for it.
Right back at you, because none of this works without the data as well. Like, what you do is foundational.
Indeed, man. All right. Well, everyone, really appreciate you sticking with us to the end here. Hopefully that was a inspirational and thought-provoking start to your week. Dan and I'm sure we'll be back on other platforms and other conversations over time, but we'll chat soon. Thanks so much, y'all.
Thanks, everyone.